Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
You're watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Cobus Potgieter from Southern Cross Capital, Shane Watkins from All Weather Capital. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392 or on Twitter @BusinessDayTV, #Stockwatch. Gents, appreciate the time. Let's kick off with some results. Shane, Redefine numbers out. Discount to NAV is giant. LTV now just over 40%. Yield not too bad. Your thoughts on what's it's about 100 billion out of assets?
Yeah, Simon, Redefine is one of the large retailers in South Africa, and traditionally these counters would track whatever the long bond yield has done. And I've made the point previously on your show that the SA long bond yield has gone from 12.5% to about 8.9%. And that's a very positive thing for any asset that's priced on a yield. So, resilient, Redefine, Hyprop, these are the kind of the large property counters focusing on domestic South Africa. I think probably the whole REIT sector is a buy if you believe that the SA long bond yield is sustainable at sort of 8.9%. And may go lower, in fact, if we get an upgrade to our sovereign rating, which Merrill Lynch are speculating about.
And I saw Kevin Lings over the weekend was tweeting, I think August, September, biggest buying of bonds by foreigners since he got data. And he says his data goes back to early 90s. Cobus, for you, Redefine, and I like the point, in a sense they're almost too big to be much beyond except maybe a bond proxy. Or do you see it different?
Yes, there was another commentator on one of your shows, the name escapes me, that said precisely this. I don't really care about movements in the underlying NAV. These instruments are priced based on the yield. Investors buy them for the income they provide, and that's ultimately the appropriate way to look at it. And I would go with the highest quality counter that you prefer in the sector. Ultimately, I agree with Shane more generally, and for the not only the REIT sector, certainly for the banks as well, that these long bonds have repriced enormously, and there is correlation between these sectors. They typically trade in tandem with the yields on the bonds, and therefore these stocks are quite cheap. Redefine has some offshore exposure, which in this particular period has maybe underperformed a tiny bit. But I think that interest rate environment in Eastern Europe actually also remains relatively accommodating. But on that basis, given that there is less SA exposure, perhaps less of a repricing is justified for Redefine than some of the others.
Yeah, they got those operations in Poland. You said the best in the sector. What would be your best in the REIT sector?
I'd say the highest quality remains Growthpoint.
Yeah.
Very well managed business. Pretty boring, but certainly my favorite.
Yeah, look, I got no beef with boring, so I take you on that. Cobus, let's stay with you a second. Altron results out. HEPS for continuing operations up nicely. This, of course, the Netstar business, that doing fairly well. Your thoughts on the Altron numbers?
Yes, well guided. We had trading updates running into this. Continuing with simplification, offloading one of the discontinued operations and focusing on the annuity revenue service-based model, quite successfully executed thus far. Looks like a decent set of results, sort of precisely in line with expectations. The only thing is that the forward-looking statement was quite cautious, effectively Werner Cup effectively signaling that the entire IT sector faces headwinds, and it seems that the market has read that as less bullishness going into H2, despite them specifically flagging that the earnings momentum they saw towards the end of H1 actually carried over into H2. So that's quite an interesting situation. but it has, I suppose, already repriced quite significantly. But I continue to like it. The valuation is very reasonable at around a 9 forward, so continues to be one of those decent value small mid-cap stocks.
Shane, for you, Altron and the numbers out this morning?
Simon, so yeah, I mean, Cobus has summed it up well, but I think the main point is, this is like a 7 billion market cap.
Yeah.
And these kind of companies of that size have become sort of orphans on the JSE. And as a consequence, we've seen quite a few of them, being delisted. So it isn't really a share that's going to attract large scale, large institutional interest. And it certainly won't attract the interest of foreigners who are one of the people that drive prices in our market.
That's a great point. And if, with respect to the small private clients, of which I'm one of, for me, driving a 7 billion business is hard. So they don't get that momentum. They can be brilliant results, but they struggle to reflect that into the share price.
Well, the other thing is, because of the change to Reg 28, where pension funds could go from 35 offshore to 45% offshore, it has made people more discriminating about how they manage the remaining assets in South Africa. And so, it really means that it's more competitive to get onto a pension fund's radar because they can take so much of the pension fund offshore.
Yeah.
And offshore, they're like upwards of 50,000 listed companies. There's a lot to choose from.
Yeah. And I mean, I was reading an article, someone who runs a mid-cap fund small cap in the US. And I think his small cap is $15 billion. And I'm like, whoa, hang on, that's our banks, to put it in perspective. Shane, to stay with you, a couple of questions coming through Thungela. One asking, is it time to dip into it? The other, is there any reason to be holding? Certainly, it had a brilliant dividend yield. It's still relatively cash generative. They've got the Australian assets. Shane, Thungela, for you?
So the problem for Thungela is thermal coal prices have fallen off a cliff. And if thermal coal prices stay at or about where they are, and I'm talking about the ex-Richards Bay price, then there's probably further downside. And generally energy prices have been quite weak. I mean, if you think that Brent is in the early 60s, it was probably $80 like 18 months ago. Energy prices have been coming down. And so it's hard to see upside in Thungela unless there's a turnaround in thermal coal prices.
Cobus, for you, Thungela, it's certainly single commodity miners always have that extra risk in terms of the single commodity risk. Thungela Resources?
Yeah, well, I guess one man's risk is another man's opportunity. In that it is a very, very pure play, exposed to the coal price more than anything else. So one of your questions was, is it worth holding? It is certainly worth holding. As a bet on the direction of thermal coal, if one believes that energy prices are suppressed and they might recover in the near term. We are not quite there, but it is, that would be essentially the only thesis for Thungela. We've seen the recovery in the Transnet rail being flagged in their results already. So that is as a sort of a turnaround thesis in of itself wasn't quite sufficient. It just means that they would have printed more super profits back in the days of super profits in the sector in the wake of the war in Ukraine. So ultimately, it's a very pure single commodity play, and that's precisely why it's a nice to have on the JSE. But for the moment, we also remain bearish on energy.
Yeah, and you need that commodity, to your point, to be going the other way. And if you bearish on the energy sort of complex, then, coal falls squarely into that. Cobus, a question coming through about Discovery. Should I worry about my Discovery with the National Health Insurance lurking down the road? I mean, there's been court cases, there's been talks in Parliament. How would you view Discovery in terms of NHI?
Look, I don't want to get political,
sure.
But I think NHI, I agree. I mean, there's a lot of uncertainty and a lot that needs to be hammered down in terms of this roadmap. But ultimately, I believe it's one of those things that will get continuously kicked down a can that'll be continuously kicked down the road, and I wouldn't let that discourage me in particular, and I'm pretty sure that we'll get to some point where the major medical schemes have a form of right to exist in whatever new regime is established. But that could take a decade from now. And in the meantime, they've leveraged the medical schemes business to build quite a nice, quite a few nice pillared businesses around it. So I wouldn't use that thesis in of itself to justify divesting from Discovery. I think there's a lot more going on, and it's essentially I wouldn't discount from a Discovery perspective too much out of the price because of NHI.
Yeah, I take your point. It's a long way away, and we're not quite sure how it's going to play. Shane, for you, Discovery in light of an NHI, which, I mean, I don't know, it is going to be many, many years away, if ever at all, and we're not quite sure what guise it will ultimately take if it comes.
Simon, I would say two things. First of all, Discovery has become quite a diversified business now. They're in insurance, they're in banking, they're in investing, they have Vitality. They have a whole range of businesses now embedded in Discovery, not just managing of a medical aid. And then the second thing is, I would say that if you had to try and identify the top 10 or 20 entrepreneurially managed, forward-thinking businesses in South Africa, then Discovery would definitely be one of them. It's got an extremely entrepreneurial CEO. The business is one of the most data-rich companies in South Africa. I think they've got something like 4 terabytes of data. I think that it's a business you just got to back management and ignore the political noise.
Yeah, and I like your point. I mean, in terms of being innovative, they're certainly there. Shane, Aspen, 25 million euro settlement announced on Friday. It's about 500 million ZAR, call it $500 million more or less. The question coming through, and I'm going to paraphrase it because it's a long question, but in essence, this kind of suggests that the cancelled contract was more about the client wanting out than around the quality and is good for Aspen. Would you concur with that? And then secondly, the issue is still, they need to start filling those sterile facilities in Quebec and France.
Simon, look, I've always said that the thing for Aspen is I view them as a company that is just a bottler. They fill stuff.
Yeah.
The intellectual property doesn't belong to them. And the problem with being, let's say, a filler or a bottler in these sterile facilities, your capex bill is quite high and your margins are quite low. I think after the enormous shock and disappointment of the cancellation of this contract, and I mean, whether there was a payment or not, the fact is the contract's cancelled and the facilities are idle. I think it's difficult to restore the narrative. And, when you are investing, in a perfect world, you want to buy great companies with great management, but really what you're doing is you're buying companies that you think other people will like more than you, so the share price will go up. And it's hard for me to see how they restore the narrative here.
I like that. Investing is around stories. I mean, it's numbers, but at the top of it, there are stories. Cobus, for you, Aspen, I take the point, it's a story. There's also a management issue, and sterile facilities, no disrespect, there are a lot of them in the world. Your thoughts on Aspen, even after getting close on $500 million in cash?
I largely concur with Shane. Not to be petty, but 25 million USD, being called approximately 500 million ZAR. That reasoning is about a year old, which is, it's closer to 430 million ZAR, which is, of course, around 1.2% of market cap. So this is essentially a stipend, a settlement, and it looks like the contract that effectively, the counterparty that effectively walked away from this deal gets to remain anonymous, which is also not great. So I agree with Sean in terms of the quality of the business. Like you mentioned, there are plenty of bottlers around, and also an inability to enforce these agreements and having to walk away with a stipend when the market was trying to price quite significant future earnings off of these projects, that is quite unfortunate. So I mean, I guess now we sit and we wait for execution around filling those facilities, and that's certainly not a great outcome. And desperate shareholders will be looking for some kind of a catalyst for a recovery in the share price, but I don't think it'll ever attract the same shine, just given that, the light has been shined and we've had sort of repeated setback after setback with the share. That credibility probably won't be restored again.
Yeah, no, I take your point on that, absolutely. Cobus, let's stay with you. Question coming through on Bidvest. I like the company. I thought the response to the results were a bit harsh. I concur with that. And it seems to have bounced quite strongly off the 210 odd support. What is your panel's view on Bidvest for a long-term hold? Cobus, for you, Bidvest?
I suppose similar to you the last time we chatted, which is funny because I dislike these conglomerates. There's sort of a lack of specialization, but of course Bidvest seems to get the so-called deal-making premium inside of it. And the deal that the market is keeping an eye on is the hygiene services business in the UK, Canada, and US. There was a significant acquisition which has led to a lot of additional gearing, and now we need them to execute, bet down that acquisition, and essentially start paying down this debt. So it's from that perspective, it's quite a nice deleveraging play, and I guess from a pure inertia perspective, it remains one of the cheapest entry points that we've seen into Bidvest in many years. It's trading at an earnings multiple that is quite a bit lower to what we are accustomed to with Bidvest. And of course, there are a lot of other individual businesses inside of Bidvest that I continue to like, also just purely as a reasonably priced SA Inc. play. So yes, I think it's still worth a flatter, and we hold a bit of it.
Shane, for you, some Bidvest?
Yeah, look, I mean, Bidvest is a big company, like 70 billion market cap or thereabouts, and is trading on a 10 or 11 PE. So, this is a SA Inc. story. I mean, notwithstanding the businesses that they have in the UK. And if you see foreign inflows, the share is going to do well.
Yeah, there's foreign inflows. I take it, and it's nice, as you said, 70 billion. It's quite chunky. Shane, question coming through. What's the best PGM miner on the JSE? I want to put in some bids lower down for a sell-off on platinum before it bounces again. Lots of nuances there. PGMs, what would be your preferred in the space in the platinum group metals?
So the PGM group metals have done pretty well. I mean, year to date, rhodium, platinum, palladium, they're all up between sort of 50 and 80%. I'm talking about underlying metals. I think we'd go with Valterra. It's by a long way the largest market cap company. It's probably got the highest quality ore reserves. Craig Miller, the CEO, I rate quite highly. And the share is going to be upweighted yet again in the indices because of the increase in the free float. So you can have additional passive buying for the share. So I'd say Valterra.
For you, Cobus, preferred PGM miner?
No, I concur. Certainly Valterra. It's become quite a chunky name in the index already post the restructuring of Anglo American. But if you wanted plat exposure, and I mean, just to reiterate, we don't necessarily concur with the question in that if it does sell off, it'll rally again. That would be a bit of soothsaying, but Valterra is the highest quality play in the sector.
Question coming through around Astral, and in fact we've had this question before recently. Is Astral worth a look with the lower input costs? That main input of course being maize, and I know they always used to show a chart at their results around what the maize price was doing and their sweet spot. They're in it. Of course, the stock has kind of preempted this, perhaps. Cobus, would you think there's some value left in Astral? I mean, it's up quite a chunk already off the lows of last year, in anticipation as this maize prices come into its favour.
I called this as one of my picks a few months ago. It was beaten down, and I mean that was really on the hypothesis, chatting to my my commodity expert mates, thinking that maize is an oversupply and that yellow maize price, which is a major input cost for them, both on the chicken business and on the feed business, of course, that should come off. And at the same time, we had an enormous reduction in load shedding, which was their most significant operational headwind. So if they could just sort of steady the ship, along with the support they've been getting in the forms of tariffs from government, it was set for a bumper set of results. In the meantime, we've had a trading statement updating to said bumper set of results, even though we didn't have the detail, and they are in fact reporting next week finally. I think one may argue the horse has bolted somewhat, but given that it remains so cheap, there's probably still a bit of upside left. Resignation of the CFO last week notwithstanding, it seems he just received a nice opportunity elsewhere.
He got a better job offer, is the short answer seemed to be it. Shane, Astral for you, can I interest in some fried chicken?
Yeah, I think it's a very good business. The IQF and fresh chicken prices are up 10 to 20%. Maize prices are down from 5,000 to about 3,600. So, both those vectors moving in the right direction. Plus, on top of that, you don't have the load shedding costs of prior years. We hear that the CFO maybe is going to join CUP. But, I think he was a competent person, but it's not a catastrophic loss. I think Astral looks pretty cheap at 10 PE on earnings growth that could still probably grow 10 to 20% per annum from here. I think it's attractive, but you must understand that this is not a buy and hold company. This is a trading stock because it's highly cyclical.
Yeah, and 100%. And to me, the challenge, I always find the buying part easy. It's the selling part I find a whole lot harder. Make no mistake about that. Quickly before we go to stock picks, Shane, question coming through around Richemont. I like luxury. I particularly want the high end. Surely Richemont is the easy pick in that regard. Would you concur?
Yeah, I think Richemont is... Look, it's one of the best businesses from a quality perspective listed on the JSE, and I think luxury is, if you set aside the seasonality of what's happening in luxury, I think it's a secular growth business. I think Richemont has always got to be a core part of your portfolio.
Cobus, for you, some very expensive fancy watches?
Yes, I like the business, and like Shane mentioned, it'll grow.
Yeah.
So from that basis, particularly if the JSE is your universe, I think we like LVMH at the moment. I think the Dior entry point is actually a bit cheaper as well at the moment. But in terms of your JSE universe, certainly you need to have some Richemont in your portfolio. The question is just how much.
Yeah, okay. And we'll leave the how much question to another day. Let's go to some stock picks. Cobus, Nedbank is your pick today. Still got a price to book of around 1x, if I remember last time I checked.
Yes, incredibly cheap in its universe. And where some of the other SA Inc. stocks have been penalized for venturing into the rest of the subcontinent and overseas, Nedbank seems to be punished for withdrawing from the rest of the continent and being a purely SA-focused business. Jokes aside, the last set of results were a little bit disappointing. But I pick it not only as a value call in of itself. It's on a PE of 6 and a dividend yield of 9%. That just absolutely screams value. It also comes back to that argument around the repricing of the bonds. The banks have been historically correlated to the yields on the bonds, and they are frankly, all of them are looking very, very reasonable at the moment. Nedbank just looks like the cheapest of the bunch. And overall, we quite bullish on both the credit cycle and perhaps even upgrades in the expectation for South African growth in the wake of course this precious metal boom and the tax take we'll get from that. We expect the consumer to start showing a little bit more health, a little bit more appetite for spend, and we think that's going to be good for the banks in particular.
Yeah, and as has been said many times in this show, 9% dividend yield is better than you get in a Nedbank savings account.
Yes.
Shane, Pepkor, loved their results. That little fintech flash business is getting proper chunky, and your pick today is Pepkor.
Yeah, so Simon, what are you buying when you buy Pepkor? You're buying a business that's 6,000 stores, 2 in 3 of every baby clothing item in South Africa sold by them.
Wow.
1 in 2 of every kid's apparel is sold by them, and 7.5 out of 10 of every prepaid cellular handset is sold by them. So you are buying what I would characterize as a platform business. And you've got to say, well, when you buy a company and you're looking at the future, which is uncertain, how many ways can they win? And this company, they can win in apparel, they can win in cellular, they can win in financial services, they could win in furniture, they could win online, they could win with Avenida in Brazil. There's a lot of stuff that can go right. And Peter Erasmus is well incentivized personally to make sure that things do go right. So competent management, strong model, everyone's incentivized in the right way. I think it's a decent story. And they came out today and they said, earnings would be up, 18 to 28%. Yeah. I mean, there's some adjustments you must do, but still, the other apparel guys are not showing nearly the same growth as that.
Yeah, and my correction, it was an update, not a set of results, but they have been executing. That's the important point. That's all for our Stock Watch today. Thanks to our guests, Cobus Potgieter, Southern Cross Capital, going with Nedbank, Shane Watkins, or Weather Capital with Pepkor. Up next, at the close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.